Hi. As I mentioned in some previous videos, a central problem with personal finance and the overall economy is that enough people just don't have money to pay for their basic needs, let alone have enough left over at the end of the month that they'd be able to save and invest. But for those who are lucky enough to have even just enough income to save something for retirement, building that savings and getting some kind of return on interest or some kind of return on principal, is quite important. And so when looking at investment, maybe you don't have a lot of money, not likely going to get rich, but you can do better than putting it in a basic savings account or sticking it in a cookie jar or something like that. You've got two basic vehicles that you're going to invest in, stocks and bonds. There are a couple other types of investment instruments that we can talk about later, but basically you've got stocks and bonds, and then you want to diversify by having both, or as many different types of investment as possible. So when you look at bonds, you're going to generally see government bonds, which is going to be the federal government, the treasury, then local government, which is municipal bonds, and then agency, like the Farm Brokers Association, or Sallie Mae, or Freddie Mac, or Fannie Mae, or something like that. Or the Tennessee Valley Authority, stuff like that, which is publicly sponsored, semi-private, semi-autonomous companies. And then corporations, which are private or publicly traded companies, still private capital. Right, and so a bond is a debt instrument, whether the government or an entirely private company, they are borrowing money from bondholders. And each bondholder pays $1,000 face value for a bond, or some sort of premium or discount on that face value. And then the bond issuer agrees to pay back that principal after a certain term has passed, whether it's 1, 5, 10, 20, 30 years or whatever. And at that time of term, then the face value of the bond, or $1,000 per bond, is what the bond is worth. In the event of bankruptcy, generally, bondholders are kind of left on the hook, much like stockholders, although in some cases for reorganization, you're going to find that bondholders actually get a reissue of bond. When it comes to treasury and other government bonds, these are very stable investments. And so that's one of our main advantages, that we're going to preserve the principal compared to investing even in property and land, certainly compared to stocks. When you buy a stock, the price could go up, could go down. There's no guarantee that you're going to preserve your principal over any amount of time. Another benefit of most bonds is that there's income. The bond issuer agrees to pay the principal, which is that face value $1,000 at the term of the bond, and all along there's generally a coupon. Now sometimes there's a zero coupon rate, in which case you get a discount. You buy $1,000 redeemable in 20 or 30 years for $400 or $500 or something like that. Now there's a discount, and then it would not pay this interest by month or by year or something like that. But generally there's a 5%, 2%, 8%, whatever coupon rate, which is like interest on the bond, and that's payable at regular intervals. There's reduced risk because of the way this debt is structured. There's not as much market force where the price of the premium or the price of the principal isn't going to rise and fall so much like you would see with stocks. And because you can preserve your principal, because you've got income, and because bonds will only fail or will only be reduced to zero value or significantly face devaluation in the event of bankruptcy, most companies and certainly countries and cities even don't go bankrupt, so there's reduced risk associated with bonds. But then, as we'll see in the negatives here, that does create less income or less profit available. And then, as part of a macro level strategy, when developing your own personal financial strategy for retirement or for long-term investing, you should have a mix of these different types of investment vehicles. And so that's an advantage of having a bond. Right, some of the negatives, they are interest rate sensitive. As the rates go up, the price goes down. As the rate goes down, the price goes up. Price and yield are also inversely related. Yield and rate is basically the same. Your yield on the bond is pretty much like your interest rate. And as the national, the federal government, or the central bank raises rates, then the price of the bond will go down, the yield will go price would go up and the yield would go down. And so there's some volatility along with raises and decreases in national interest rates. And then so that kind of follows the overall market and the economy. There is a little bit of market risk, although again, you go ahead and preserve the principal so long as you hold the bond to term, right? Again, like I said, there's a lower return. Generally in capitalism, people justify or rationalize getting profit because of the risk. And so, given that there's lower risk in bonds, because you are preserving principal and you're getting just a consistent income stream, then there is lower return compared to things like stocks and riskier investment vehicles. So there's an opportunity cost there, we could say, that when you're not taking that money and investing it in a higher return investment, then you're kind of losing an imaginary opportunity cost or economic cost. And then of course there's a small percent chance of default, whether at the company, definitely company more so than agency or government, but even some governments go bankrupt, certainly at the city level, and some countries in fact go bankrupt. So there is a small chance of default, in which case it's possible that you would be reissue the bond after reorganization, but not entirely likely. Right, so we've got some pluses and minuses, and in a moment I'll look at some details about how bond markets work, how they compare to different stock markets, and what to think about when going to buy a bond.
So if you wanted to buy a bond, you could ask a brokerage house or whatever online application you might use about a specific bond, or you could buy an ETF. There are exchange-traded bond funds, in which case you wouldn't own the actual bond, you'd own an interest or a stake in a batch of bonds. And you can find ETFs based on the different gradations of bonds, from high yield or investment grade, which are, according to the three main ratings agencies, Moody's, S&P, and Fitch, of AAA down to triple B minus or Baa3 at Moody's. And these are the investment grade bonds, and they're going to be lower yield because they are lower risk. Generally, I think it's recommended that if you want to protect your principal, and that's one of the main advantages of the bond purchase as an investment, as a way to diversify risk or minimize risk, those AAA rated bonds are the way to go, although you're going to get lower yield. So if you wanted to take a riskier approach, then you could invest in any number of different junk bonds, which are going to have substantially higher yields, but also extremely speculative, default imminent down here in the C range, triple C range. Highly speculative is in that B range down here. Again, anything in double B plus or lower is not really considered investment grade bond, but it depends on what type of risk tolerance somebody has and what type of returns they're looking to get. And so typically, again, you could look at a government bond, which is going to be lower yield, lower percent profit per year, but much lower risk as well. Or you could look at a general corporate bond, which is slightly higher yield in that investment grade range there. Slightly higher yield, slightly higher risk, looking down into the higher yield, which really does rise and fall. The yield on the junk bonds changes somewhat with the wind, with the macroeconomic variables. You could find a bond paying as high as 4, 5, 6%, which is competitive with stocks in a lot of cases. But they are, again, sufficiently more risky investments. Right? And we can see a slight decline in high yield bond issuance over the years, that there are fewer junk bonds being issued, different tighter controls on the way the government allows companies to finance and diffuses risk out through the population through taking out loans from individual investors. And so if we want to compare bonds to stocks, again, this is a main advantage of stocks and a disadvantage of bonds. And the reason people are buying bonds is not really to make that profit, which is why the investment grade bonds are typically paying at between 1 and 3% on a 30-year, which is quite a long time to hold any asset. Now, the Dow Jones Industrial Average is performed at roughly 13.5% on annualized return over 5 years compared to S&P bonds. These would be the riskiest bond categories. This would be the corporate bond, 5% per annum per year. And then if we look at municipal bonds, those are at 3.5% roughly over 5 years. And then finally, treasuries, we're at about 2.12. And we've moved into this zero rate environment. You can see the bonds in all categories have reached a relative peak, relative maxima, and maybe just slightly below the relative maxima in all bond categories. And that suggests that the price is the highest and the yield is the lowest as they have been in quite a while. A couple years ago, when the Fed was raising rates in the United States, the bond prices sunk and the yields rose, and then people who bought in this period saw their asset value increase with the prices. But if people are buying now, then they're going to get lower yield, and they face the possibility of then a decreasing asset value unless they hold it to term, of course. If you hold to term, then you're always going to get that face value. So one of the main advantages, again, and just to reiterate, main advantages of bonds as compared to stocks is to preserve principal and reduce risk. But one of the main disadvantages, as you can see, is the rate of return, especially over the long term. Now, bonds provide that consistent growth, and this is an index here, whereas the face value of a bond is always static. It's just 1,000. But if you buy into an index fund, you'll get coupon payments, or what they might call dividends or disbursements. But then you could turn around, there's always a secondary market for bonds. So as these prices, these indices rise and fall, then you could buy or sell in a secondary market in order to kind of play a second element in trying to retrieve profit or trying to maximize profit from bond purchases and sales. So each individual investor has different needs and different interests and different abilities to watch the market and kind of predict the market and try to play on what the market might do. So we can't say that every bond holder is going to hold a term, of course, and a lot of bond holders have in fact sold at this relative maxima when they might have bought low here. Even if they bought intending to hold a term, they might sell it up here because this increase in price actually reduces the number of years that one would have to hold the bond in order to recover that value and in order to gain that value. So it depends on various conditions in the market with the interest rate, and then when dealing with corporate bonds, what the bond gradation is and what the company short, medium, and long-term future is. But again, if you're looking for shorter-term gains or larger gains as far as increasing the net value of your portfolio, then you're going to have to diversify into more risky investments like stocks, which we'll talk about in the next video. Thank you.